Hi, this is Yoder with another thought about trading as we head into the new year. Received a lot of emails recently over the Christmas break because I have not been trading and talking about that decision and why essentially why wouldn't you go into the market and try to squeeze value out of every single session that's made available. I really think that not trading is almost more important to one's bottom line than the trading decisions that you make. And most people are very flummoxed, especially on the beginning side of the learning curve, where you're spending all of your time and focus trying to learn how to pick your trades and when to enter and exit. And you really don't ever think about the opposite side of that spectrum, using your market analysis skills to determine when it's time to sit aside and not take trades. So I thought I'd take a moment, do a quick video here to show you exactly that thought process and its actual consequences here as we move through what has been a very slow and dead Christmas, well, last week or two. If we look up here on the daily chart, this is the S&P 500, the ES. We can see that the market essentially bounced and then rallied up, testing Yoder angle resistance, at which point the market rolled lower, made a higher low, broke through Yoder angle resistance, and has done nothing but hug the angles ever since. We've seen an increasing lack of volatility. Volume has dried up. It's been a very quiet period for the markets. So on a daily level, there really aren't many patterns to be played. The last pattern really that was valid was this reversal bar here, which certainly was a long signal according to most of my trading methodologies, but as you can see, it would have produced almost nothing. So in a low volatility environment, it's time to move down into the intraday markets, where you're still going to see some trending action either to the bullish or bearish side, depending on where the market is in relationship to its daily range. And if we just go back a couple of days, let's go back to let's see, the 22nd here, just moving into the beginning of Christmas. Really, the last time we saw any interaction with the Yoder angles themselves. Well, the market gapped up, tested the Yoder angle resistance, and made two topping tails. So there is a very clear test of resistance with actual confirmation from the intraday market. At that point, normally I would go short and look for a retest of the lows and perhaps a bit of a breakdown. Here you can see the low right around 875 would have been a logical profit objective. Obviously, that trade would have stopped out as the market moved up through resistance. Then I'd be looking for, since resistance was broken, I'd be looking for a long trade. And normally the first pullback after a break of resistance is my bread and butter. So I absolutely would have been long somewhere either within this bar or definitely this bar with stops set under these lows. Would have had an hour or two of positive action, and then the market based and broke down, giving me two stops there just in one session. Very valid trades, very clean price action. This is the sort of thing that you've seen me trading for the last 6 months that we've been going through the beta test here on yoderangles.com. But on this day, you would have had two swings and two misses. So that's basically 0 for 2. Okay, next session is the 22nd now. Here we have pretty much a straight downtrending day. Solid movement to the downside, a bit of capitulation. Would have probably taken a long in that capitulation, either in this bar or this bar, looking for a bounce back up towards areas of resistance. And unlikely that I would have taken the full stop here because of the lack of action. Normally after 3 or 4 bars, if nothing's happened, especially on an intraday trade, I will scratch the trade and either take a small gain or a small loss. So we'll call that a wash, but nonetheless, still a failure. The next day, we have a bit of a gap up. The gap holds through the first 30 minutes, which is a critical time, rinses out the lows, and then immediately zips back to the top. And if one bottoming tail wasn't enough, we printed 2. So that would have definitely got me long. As you know, I like to trade in that 10:30 to 11 o'clock time frame. Probably the majority of my day trading gains come from that time zone, so would have been active there. Would have got a setup and a flush, so that would have been probably a full stop. Unlikely I would have gotten a scratch off on that, although I suppose there's an outside chance. But we'll call it a loss. So there we are. Now we're down 3 losing trades here and 1 scratch just in a couple of days. Nothing really here that would have gotten me this higher low. Perhaps would have been interesting, but quite frankly, it set up during the doldrums, the noontime doldrums, which is a very low probability time to take entry. So I probably wouldn't have taken it. The rest of that day would have been a wash for me. Obviously, Christmas Eve, unlikely to have anything very important happen, and it's a half day, so we'll throw that one away. Very unlikely I would have traded that in any case. But then, if we go back here, we can see there's a fair amount of support right around 865. And that market gapped up and sold back down to test that support level, then made a bottom, turned back to the upside. And the thing that's interesting to note, though, is that I would have been buying right into support. So it would have been rinsed out here on this long as it came back down and then moved to the upside. So here we are moving through essentially a trendless period on the daily. Almost all of the standard patterns and practices that I employ, which deliver me great edge, and obviously from the trading record I posted there, have delivered again and again through all different kinds of market environments over the last year. They haven't worked. It's been a 100% failure. So just there, we're looking at essentially four full stops. And normally I'm risking $2,000 to $4,000 on those trades. So looking at some very serious some money in excess of $10,000, 10 to 12, maybe 14 if you were unlucky. That essentially I didn't lose by making a positive decision to not trade. So rather than walking away in disgust or using negative emotions to make that decision, I did this, made this choice that cash is king in a very positive way from past experiences, knowing that the Christmas season is often waffly and that the best patterns come and go without too much positive follow-through. So it's important to note the differences that these results will make in terms of actual monetary value for your account. Let's say you have a $100,000 account and you're risking $1,000 on every trade, so it's a 1% risk. Going over this last couple of days, you would be down 4 units or $4,000. Well, in order to up the stakes and get to new equity highs, you now have to make back the 4,000 you lost, plus another 4,000 to basically be up those 4 units. So you're 8 in the hole, so to speak. By not losing, by not taking that drawdown, the next winner goes directly into the profit column and will move your account up into new equity highs. And this is something that I always spend a great deal of time with my private consulting clients too, when we are analyzing their edge and looking for ways to make their trading programs better. You actually get a much bigger bump in terms of actual dollars earned at the end of your quarter or your year, however you choose to measure your success. You get a lot more value out of avoiding losses than you do actually getting gains. Ironically, as that sounds, they did a study, and I'm trying to remember what firm it was. I think it was a money management firm, perhaps 8 to 10 years ago, and they discovered that the average investor spends 70 to 80% of the time with their account below the peak of equity. So essentially, you spend your life in this business losing. You have big surges in equity, which drive you up to new highs, and then the market pulls back, it acts a little bit funky, and you end up losing a little bit. Managing those drawdowns, therefore, is really your primary focus and your primary task as a professional trader, because by definition, as a pro, you're going to be here day in and day out. And how you manage those inevitable losing markets, or losing market environments more accurately, is really crucial to what your bottom line is at the end of your quarter or year or whatever your reporting period is. So there you have it, a little something to think of as we go into 2009. Hope it helps you eliminate some losses through this normally tough holiday period. We're heading into what should be a really interesting time surrounding the inauguration and the first 100 days of the Obama administration. I think there are going to be a lot of great opportunities there, and really look forward to trading in that environment. So stay tuned, and as always, interested in your feedback, you can reach me at bo@yoder.com. As always, thanks for listening. My name's Bo Yoder. Good luck and good trading.